Supermicro computer, which was a hot play on the build-out of AI centers, posted earnings yesterday, and it did cut its 2025 sales guidance. Our guest says the results were terrible. You can see the stock is up around 4% today. He's bullish on the stock. And let's get to this and other earnings, including Lyft, whose stock fell almost 10% today. We're joined by Sahak Manuelian, Managing Director and Head of Equity Trading at Wedbush. Thank you very much indeed for joining us.
Thank you for having me, Andrew.
Start off, if you would, with Supermicro computer. You are bullish on the stock, even though you weren't impressed by the latest results?
That's correct, Andrew. The results were not good. The December quarter was not good. They lowered full-year revenue guidance. Blackwell delays, impacts from their own 10K filing delay, which has been ongoing. But they came out and gave a very bullish full-year 26 revenue view. So we think that the stock is worth another shot here, and it looks quite interesting. It's trading up maybe 3% or so on the heel of the earnings release with this fiscal 26 revenue guidance.
What about concerns over their accounting? Their auditor resigned. There were fears over the reliability of their books. Have they put that behind them now?
I think it's still ongoing, quite frankly, Andrew. However, I think most importantly, a lot of this news is already reflected in the price of the stock today.
Oh, okay. So discounted right now, yeah, the shares losing half their value in the past year. What about Lyft? We did see some selling in that name. What's your take on Lyft?
So, it's Lyft and Uber. Uber is certainly ahead of these guys, but Lyft is trading down. I think it was down maybe 6% or so last I checked. Their Q4 EBITDA came in a little bit better. They announced a $500 million buyback, but sales and bookings were both a touch light, and bookings guide for Q1 falling short of street expectations. So the stock's getting hit on the heels of that.
Would you be a buyer of Lyft right now?
We like Lyft here, and I think it's worth buying here. I think valuation-wise, it makes sense and is compelling at these levels.
They have been doing well with some fixed price offerings to airports, or at least for commuters anyway, so people know what they're going to be paying.
Yeah, we think the story's coming together. We think that this guidance is now in the stock, and we think this retracement in price is worth buying.
Kraft Heinz, the whole processed food industry is something of a tizzy right now. We don't know if Kennedy at the Department of Health in the U.S. will actually achieve big changes in processed food, but also there are worries over the diet drugs. Kraft Heinz coming out with a lackluster forecast.
Yeah, right. So for Kraft Heinz, organic sales missed street expectations because the higher tax rate didn't help these guys either. Technically, the stock looks like it might be in some kind of a double bottom type formation. Open near the lows, it's recovered quite a bit since then, still trading down a few percent. Look, to your point about these GLP-1 drugs and the effect that they've had on processed foods, it's certainly been an overhang for these. However, we like the consumer staples as a sector here and think that we can see further rotation out of some of the winners from 2024 into some of the laggards. And we think the consumer staples sector as a whole should benefit. And we think Kraft Heinz is looking cheap enough to start nibbling at and buying at these levels.
What about pretty well our flagship technology company right now, Shopify? What is your take there? Would you be a buyer of SHOP?
Yeah, Shopify trading down a little bit. We think the stock looks pretty attractive here. We like the setup. They reported earnings yesterday. The earnings were good. There was nothing bad about the report, I don't think. There wasn't a whole lot of material upside, and I think any knee-jerk disappointment, if you will, should be a buying opportunity. There was a upgrade in the or price target raised from a broker dealer this morning, and stock's down a few percent, but we like the setup for Shopify here.
Finally, what is your take on the market here? Because there's fears that we'll get no more interest rate cuts from the Fed, at least for 2025. Are you inclined to lighten up on stocks?
We don't think so. We think stocks still look attractive. We just think that it'll be much more stock selective. Futures, coming in this morning, futures were fairly steady. And then after our CPI print, futures got hit pretty hard. CPI came in a little bit hotter than expectations were. So, futures got hit. Stocks are getting hit this morning. I don't think we're down that much, quite frankly. And we've actually recovered from the morning lows. I think stocks still look attractive. I just think that it'll be more than just the mega cap stocks that will work this year. And we think areas such as healthcare, consumer staples have some decent tailwinds behind them. So we like stocks here. We just think that it'll be a more diversified portfolio that works to the upside. And we think breadth, which we've seen broadening out, will continue to broaden out.
We just had a chart there. We didn't get a chance to discuss it. Maybe we'll put it up again. It addresses bear sentiment. And so what do you think? Is the market sufficient, or is sentiment out there sufficiently bearish to push the market higher? I'm just looking. So that index, the individual investors line, that's a measure of how people are bearish?
Yes, thank you for including that chart, Andrew. This is something that we keep a close watch on. So sentiment, or that AAII bearish line that you see moving higher, what we're saying here is that bearish sentiment has been increasing. And so long as investors remain bearish, we think that stocks can continue to trade higher. And so, if you just take a look at the S&P, it's been in this well-defined uptrend. We think it continues, and we actually think there could be more risk to the upside near term, even as market valuations aren't exactly cheap. But yeah, the AAII we keep a very close eye on. We think that it's more important to watch bearish indicators as opposed to bullish, as bearish indicators, in our view, give a better reading of exactly what investors are thinking or feeling.
Thank you very much, Sahak. I really appreciate it.
Thank you.
Sahak Manuelian.